Overview of investment classifications. Intercorporate investments are classified according to the degree of influence or control the investor has over the investee. Investments with little or no influence are treated as financial assets. Investments with significant influence are classified as associates. Joint control results in joint ventures, and control leads to business combinations and consolidation. In practice, ownership percentages provide guidance but are not the sole determinant. Generally, ownership below 20% suggests a passive investment, 20% to 50% indicates significant influence, and more than 50% implies control. Analysts must evaluate economic substance rather than relying solely on ownership percentages because governance rights, board representation, and contractual arrangements can alter the appropriate accounting treatment. Accounting methods by classification. Each classification requires a distinct accounting approach. Investments in financial assets recognize dividends and interest income in earnings and are measured according to IFRS 9 classifications. Investments in associates and joint ventures generally use the equity method, under which the investor records its proportional share of the investee's earnings in the income statement and increases the carrying value of the investment accordingly. Dividends received reduce the investment account rather than being recognized as income. Business combinations require full consolidation, where the parent combines the subsidiary's assets, liabilities, revenues, and expenses with its own financial statements. Non-controlling interests are recognized when less than 100% ownership exists. These accounting differences significantly affect reported assets, liabilities, revenues, and financial ratios. IFRS 9 Classification Framework. IFRS 9 classifies financial assets into three primary categories: amortized cost, fair value through profit or loss, FVPL, and fair value through other comprehensive income, FOCI. Classification depends on both the entity's business model and the characteristics of contractual cash flows. Debt securities may qualify for any of the three categories, while equity securities are measured at fair value and generally classified as either FVPL or FOCI. The framework aims to align accounting treatment with the economic purpose of holding the investment. Understanding the classification process is essential because it determines how gains, losses, and valuation changes affect financial statements and ultimately influences the interpretation of financial performance. Amortized cost and FVPL accounting. Debt securities qualify for amortized cost measurement when they are held to collect contractual cash flows, and those cash flows consist solely of principal and interest payments. These securities are reported at amortized cost, and interest income is recognized using the effective interest method. Changes in fair value are ignored unless impairment occurs. FVPL classification applies primarily to trading securities, derivatives not designated as hedges, and certain instruments whose characteristics fail the amortized cost criteria. Under FVPL, assets are reported at fair value, while both realized and unrealized gains and losses are recognized immediately in the income statement. Consequently, FVPL often produces greater earnings volatility than other classifications. Fair value through OCI and reclassification rules. FOCI represents an intermediate classification between amortized cost and FVPL. Securities classified as FOCI are carried at fair value on the balance sheet, while unrealized gains and losses are reported in other comprehensive income rather than current earnings. Interest and dividend income continue to be recognized in the income statement. This approach allows financial statements to reflect current market values without creating the earnings volatility associated with FVPL. Under IFRS 9, equity securities designated as FOCI cannot subsequently be reclassified because the designation is irrevocable. Debt securities may only be reclassified if the entity's business model for managing those assets changes significantly. Analytical implications for CFA candidates. For financial statement analysis, understanding investment classifications is critical because different accounting methods can materially affect profitability, leverage, asset values, and performance metrics. FVPL securities create greater earnings volatility because unrealized gains and losses pass through net income, whereas FOCI shifts valuation changes to equity through OCI. Amortized cost provides more stable earnings but may not reflect current market values. Analysts should evaluate management's classification choices, business model objectives, and the economic substance of investments when assessing financial statements. Mastery of these classifications enables CFA candidates to compare companies consistently, identify potential earnings management, and better assess financial risk and investment performance.